Okay, I'm going to get started here, and this is part two for BISS 1123. So go in here to the course modules, and as I said, as we have been, we're working ahead on these cases, and yesterday we worked on the cases from, we took a look at those from 10, and then we worked on those from 11. I felt like that the example was very, very clear in terms of what we were doing, and we covered that. And I was not comfortable, though, in terms of what we did with the annuity cash file that's over there in Chapter 8, the XNPV file, or the mortgage practice file. So what I've done to make it a little easier for you is I've gone into Vital Source and I've pulled out text, and I've put it as an inserted into these files. So that's why you see these files called NPV with annotation. I also want to make sure that you get a sense of some of the different ways we look at NPV. Now, I'm going to just show you again this one. We'll open this up, and this is the XLS 11 done. And it will enable the editing. And here, as you recall yesterday, this was a company that was going to buy some equipment, and the equipment, the initial investment was going to be $640,000. Now, the company was going to realize additional income from that investment of $130,000 starting in year 9, going all the way over to year 2014. Okay, now once we're through using it, the company knows that it has a salvage value, so it can be sold. It can be sold intact or sold in parts, but it has a salvage value. So that's where we get the annual net cash flow. This is very, very typical of what you would see for a capital project. All right, and we use the NPV to calculate that. Now, we talked about the fact that money does not hold its value, and we use what we call a discount rate or an interest rate. All right, and the whole idea of it is this. There's two pieces to this thing when we talk about what we call the capital hurdle rate. One is inflation. What will this money buy me? What will $1 million buy me in 20 years? It certainly won't buy me what it will buy me now. The other piece of this is in terms of what we call reinvestment risk, and that is if I, as a shareholder, could make 12% on this investment of $640,000 as opposed to 10%, okay, then I have an obligation to take the money and invest it in a project where I could make 12% instead of 10. So we use that discount rate to say, well, what is it worth in today's dollars? So as you can see, we developed this. Really, we did two things here. We learned about the time value of money, and then as you'll see, we did a sensitivity table. You remember that. And notice that everything here, and I'll move this up here, everything here is tied together with a cell reference or is part of a function. Okay. And we do that to create the linkages that have to occur in here in order to create the data table that we'll see below. And here we get over, here we see that over the 6 years we talked about this, we're going to get $990,000 in cash flow. And then we say, okay, what's the present value? And we use the NPV function. Now, the textbook, like many of these textbooks, can really get you confused by using the formula and taking bits and pieces of it. As you'll see here in a moment, I went ahead and just, that's why I call those files annotated, and I'll show you the files out of the text. This is that example file. But here's the rate, okay? And that's why I like, the book's going to show you a raw calculation of the NPV. I don't like that for a very simple reason. You don't have anything that will really just tell you. And look, you're going to take a finance course. You will memorize that formula just like you will for XNPV and some other formulas. But when you have the function here, it's important that you understand what this is. So we've got the rate. That's the discount rate. Then we have the values, and those are the values, those are the annual cash flows, annual net cash flows, excuse me, over that period of time, okay? And we come up with the 684. Now, the cost of the investment was 640, and the net present value was the present value of the investment, okay? So that $990,000 is worth $684,000 in today's money. We subtract the cost of the investment. It's also known as the, I won't get into sunk costs, but and then we get the net present value, and that's $44,000. Then we get a thing called the profitability index. Let's look at this for a moment. In the profitability index, and I think we'd earlier had done some accounting ratios and financial ratios. Ratios clean up data. They take out the distortions of scale. And for example, if I'm Apple, for me to grow 15% a year is a massive amount of business because Apple has a huge sales figures. But if I'm a company that does $50 million a year, to grow at 15% is not that formidable a task. It's still 15%, but in raw dollars, it's not that much. So we see that the profitability index is B24, okay, the present value of the investment over B25, which is the cost. And that only makes sense. It says, what kind of return did I get for my money? All right. And what this is going to tell you is that for every dollar you invested, you made 6.9 cents. You made basically about a 7% profit. Now, we talked about yesterday, and I've spoken with you several times, when we make decisions out in the real world, they're not black and white. They go along a continuum ranging from something that was a really stupid decision and really probably created a lot of problems to a really smart decision to a good decision, some good, some bad, some ugly, but pretty much in the middle of the road. So we want to find out if I change certain variables, if certain conditions should change, what will it look like then? And that's what we call a sensitivity analysis. And we did the sensitivity analysis in the table down here, okay? And as you can see, this is a 2-variable data table. All right. And notice here we referenced back to the profitability index. Okay. And then we took various levels of interest rates, ranging in increments of 0.5% all the way over to 13%. Okay. And then we said, okay, right below here, and I call this kind of the hinge of the data table. Then here, I said, okay, the amount of annual income that I'm going to get. Okay. Then annual net cash flow. And I said, given these different levels of net cash flow. Let me see if this was the I think this is, yeah, the additional, pardon me, the annual addition income from the investment. I'm sorry. Given these different levels of annual income that possible values, okay, of annual income. So here we have these different possible values of interest rates or discount rate. And here we have the possible or a continuum of annual income. And we say, okay, well, what does it look like? Now, one of the ways I can test to see if I've done the data table correctly, and what I would do is I would just simply I would highlight this whole thing, okay? And then I'm going to invoke the data table, all right? And I'll show you right here. This is the table, okay? And here it's we're using the table function, and we're using B10 and B12, okay? Now I'm going to go down here and let's just play with this for just a second. All right. And I'm going to copy all of these interest rates. I want hopefully to show it to you in action. Here are the different interest rates. Okay. Now here I'm going to equal B27. All right. And then I'm going to copy these figures here. And these are the annual incomes. And they're increments of $10,000 up to $160,000. Well, I need to copy those first. So I'll do Control C. And then I'll paste them. So I want to copy. I'm making this a lot harder than I need to. Copy. And then I'll paste everything. Okay. Now I'm ready for my data table. Now I'm going to click on data. All right. And I'm going to come over to the what if analysis. And I'm going to click on the data table. And it says, see the results of multiple inputs at the same time. What the data table lets us do real quickly is, and I use some conditional formatting here, okay, to show you what are the possible outcomes given certain inputs. What do they look like? And then I use the conditional format to demonstrate pattern. So we're going to use the data table. And it says the row input cell, and the row input cell is going to be, I think, B12. Let me look at something for just a minute. Okay. B10 and B12 is what I want, B10. I have to think my way through that sometimes too. So I want B10 and B12. All right. I'm going to do the data table. And my row input cell is B10. All right, and my column input cell is B12, okay? And I'll click OK. Unless they're in the same size or shape. All right, well, let's just do this. We've got everybody over to 13. All right. And I don't do data tables that often, so I just kind of have to walk myself through this real quickly. So I'm going to do the what if analysis, the data table. That will be B10, and the column input will be B12. Now let's see if I did it the right way. Probably didn't. Oh, I did. There we go. Now, what I had to do, and again, I had to take the whole array starting here. And remember, here's my hinge, okay? And so what this does is this connects you back to the entire set of equations that are done up here in that area. Now, I'm going to take these and bring them to 4 digits, a maximum of 4 digits past 0. So I'm going to click home, and I'm going to decrease the decimal points down to 4. Okay? Now, let's check our work, and I'm going to take a look here. And at 10% interest and at $130,000, I'm good. So I've got the table created. This lets me see at different levels of discount rate or interest and at different levels of annual income, what does it look like? Now, I use some conditional formatting, okay? And it was very simple. And I can do it row by row, okay? And I can just use color scales, and I'm going to go from green to red, okay? Let me hold on with this for just a second. Try to remember how I did this, and I think I'm going to highlight the whole thing. Let's see what that does. And again, like I said, I haven't done this in a bit, so. And I'm using the conditional formatting and the color scales. I'm going to go green. There we go. Green, yellow, red. Yeah, that's what I did. So I duplicate. Now, so what was the point of that? Well, as you could see, and we talked about this yesterday real quickly, okay, because I don't want to spend too much time on this. I want to move on to these others. But this is more like a typical business problem. These other examples we see are more like an annuity for a person, okay? At 7% of discount rate or interest rate, if I'm getting $100,000 a year in additional income, I am basically, for every dollar I spent, I get 96 cents back. Now let me say this. Here's one extreme. Here's another. And you could see that rainbow pattern as it emerges. And you can see that the higher the annual income, the higher the profitability index, regardless of the higher the profitability index. Now, notice that the higher the interest rate, the lower the profitability index. Okay? So that's pretty much it. That's it in a nutshell. And I just wanted to show you how it's done and how we use this to show a pattern. We talked about that pattern. So I can say, if I wanted to, I could highlight this as a base assumption. Okay. And here's my worst case scenario in terms of discount rate. I mean, my best case scenario in terms of discount rate. Here's my worst case scenario in terms of discount rate. Here's my worst case scenario in terms of annual income. Here's my best case. And you'll see that's why we use the data table, and we use that and click back on data, and we did the what if analysis. Okay? So that's pretty much it. Now, I'm not going to save that, but I think I've shown you how to duplicate it, so how to do it. So, and I have it over there for you, so no big deal. I'm not going to save the changes. Okay, let's go on to the rest of the files, and we'll talk about these. And we have the annuity cash file. Okay, and I'm gonna go to the next one with the NPV with the annotation, and I'm going to download it. And I have annotated this, meaning I've gone into the relevant part of the text and I've pulled the text out. Having the digital textbook lets me do this. And so I pulled some of it out, and the verbiage is pretty heavy duty in this text. I understand it. So that's why I focus you on a particular figure, and then here with the annotation, I'm going to do that. So let me open this jewel up. Okay. And I'm probably going to have to mess with this a little bit to get it over. And to move it. So there we go. Okay. Now I want you to take, because this is right out of the textbook. They ask you, what's the net present value? Okay, how do I use this? I've explained that. How do we use the NPV function? We've covered that. It says, how can I compute NPV when cash flows are received at the beginning of a year or in the middle of a year or even at the end of a year? Okay. Now, most of the time, if we work with an annuity, okay, let's say you retire and you draw an annuity, you're probably going to be paid by the month, which complicates things a little bit. Some annuities pay you, quarterly, some pay you annually. That'll be something that you'll set up with if you have an annuity in terms of how you're paid. All right. And so we're concerned that because the timing of the cash flows is important. Now, they give us a couple of investments, all right? And we have investment number one, and they show us the cash flows. Let's walk through this. This is investment one, okay? And at year one, and this is the interest rate, okay? That's R, or the rate of return. Here we invest. Let's look at year one and year zero. Pardon me. We put in $10,000. Okay, this is one cash flow scenario, and then in the second, and then at year one, which is actually 2 years now. Year zero, year one. At year zero, I get $24,000 back. This looks more like a business project of some type than it does just a personal annuity. However, when you get an annuity, and you remember, if I'm going to draw the same amount every year, okay, I have to have a minimum amount of money in the nest egg to draw off the interest. You remember I showed you at the start of all of this, the formula for a perpetuity. Perpetuity is a little different because it's it's a fixed amount of money, but a fixed amount of money forever, meaning perpetuity. So if I have $1 million, all right, and if I want to draw $100,000 a year, okay, and the safest rate of return on my nest egg is 2.5%. Well, you can do the math. This is the perpetuity. I'll do it again for you. This is the nest egg. I want to draw $100,000. Here's my annuity. Here's the amount I want to draw. Okay, this is a fixed rate, and I'm going to earn 0.021%. Right now, if you have a safe CD, quote unquote, you're earning about 0.015, about 1.5% interest. Okay, let's say that's what you're doing. Now, all right, here's the amount of money I want to make, and let's cut that down to $100,000. Okay, and the formula for perpetuity is this, and it equals, here's the monthly income, here's the annual income I get, divided by the rate of return on my nest egg, okay? And that's how much money I have to have in there. It's giving me this value thing. There, I know I did here. Now I'm ready. So I'm going to take the annual income I'll draw. I'm going to divide it by the rate of return on my nest egg, the amount of money I've got in the bank that I draw off. Okay. And you're not being very nice here. Okay. Now I'm going to put the commas in it. Now what this says is, if I want to draw $100,000 a year on an annuity, okay, and the safest investment for my nest egg, I can earn 1.5%. I'm going to have $6,666,666. You could call it 6,000 or round it to 667. I'm going to have that much in the bank. Now, obviously, if the rate of return's higher here, the less I have to have in terms of a nest egg. Okay, that's why you need to start saving now and save as much as you can. So you have that. Now we've got a little bit different critter here because we've got this. We're looking at these uneven cash flows. So in this first investment, okay, in year zero, okay, and we put in $10,000. We put in $10,000. Okay. Then in year one, we from that investment we got $24,000, and then we reinvest $14,000 in year two, and we compute the total cash flow. And that's pretty simple. It's the sum of those, and we end up with a zero. All right. Now, I have a second investment I can look at, and here are just the raw cash flows. All right. I'm going to put in $6,000. All right. Then at the end of the first year, I'm going to put in $6,000 in year zero. At year one, I'm going to get $8,000, and in year two, I'm going to put out another $1,000. You see, if you draw an annuity, okay, from the people who run the annuity take your money and they invest it, and if they give you a guaranteed rate of return, then they've got to give you that rate of return. They've got to give you that income, okay? And so when you have like what's called a guaranteed income account, the nest egg, all right, never changes that dollar amount. What will change will be the amount of money that the nest egg earns. Typically, you're locked into something for like a bond or a government security that says, I'm putting $1 million in here. I'm putting $6 million in here, for my example, and for the next 25 years, I'm going to get 1.5% of that. Okay? That's why those are not as volatile, say, as accounts where you're primarily in equity or stock. All right, so now we get the cash flow. So we've kind of looked at the raw data here, and now we're going to look at the present value. And let's talk about this for a minute. The present value, okay, for investment number one, okay, the present value is it equals C5, and that is in year zero, I put $10,000 in. In year two, it changes. Okay, the present value of that money is $20,000 instead of $24,000. You say, how did that happen? Why? Let's go down here for a moment, and I went ahead and pulled this out of the textbook for you to show you the formula for the time value of money. Here's investment number one. Okay, I put in 10 grand. That's the minus, means I have a cash outflow. And I add that to, okay, the 24,000. You say, where'd you get that? Okay, well, the 24,000 is what I put in year one. Remember, in year zero, I put in, this is my initial investment. And then in year one, I put in 24 grand. And that's divided by 1 plus R, or 1 plus the interest rate. And here's that the denominator. And that's to the power of whatever year you're in, 1, or in year 2. That's all. And that's what the exponent's up here about. And so as you calculate that out, you get the 277.78. Okay? And then we calculate this here. And notice here we're taking E5. We've taken out and we're dividing that minus 14,000 by 1 plus 0.20 to the fourth power. To the second power, excuse me. Now, this is going to be helpful to us because down here at the bottom, when we want to say, okay, well, what does it look like in the middle of the year? I'll just be able to invert it and do the square. Okay. So that's the present value for investment number one. Okay. And here's the present value in terms of year two, scenario two. And here it is at year one. Notice this is D6. Okay. And D6 is the 8,000. And that's divided by 1 plus R, so 1.20, okay, to D4, which is going to be 1. And then it's plus minus 1,000. Okay. And we take that minus 1,000 divided by 1.20 to the second power, and we get minus 27.78. There's the sum of those. Present value of investment one. Here's the sum of the present value of year two. If you look down here, and I want to help simplify, let's go back over this formula real quickly. And this is for investment one. For investment one, we put in $10,000 in year zero. Okay? And anything to the zero power is itself. We'll do this. I'm going to put in 10. And I want to find my little hat there so I can make it an exponent. There we go. And a 10 to the zero power. I'll put that in here. This equals. Okay. 10 to the zero power is 1. Okay. So we put that in there, and we've got at year zero, if I put in 10,000, I've got the 1. So I've got this initial investment, okay? And most of the time, we don't do the year zero simply because it can confuse us. Year zero is an initial investment, okay? And so we just say, all right, we're just not going to deal with the zero part, but we will deal with 1 at year 1. And so here's the initial investment, the minus 10,000, okay? That's what we paid. And then here's the 24,000. That's what we got in year one. Year zero was minus 10,000, or the initial outlay is what we call it, 24,000. And we divide that by 1 plus R to the first power because it's year one. Here, and then we see, and that's plus the minus 14 divided by 1.20, because that's 1 plus 0.20, to the second power, okay? And so we accounted for year zero, year one, year two, and we get 277.78. Now notice down here, this is the second scenario. Our initial outlay is 6,000. We add that to the 8,000 we get in year one. We add in the cash outflow in year two, and we come up with 27.78. Notice we start with the initial investment, and then we start with the cash inflow or outflow, and that's divided by 1 plus the interest rate to whatever power, to n power, and the n is year one or period one, period two, etc. Now it gets a little trickier when we go over here and we start doing it at the beginning of the year. Okay, and we assume here in this first one at the beginning of the year. Notice it matches this formula. We say the end of the year, it's a different critter. Okay, you say why is the present value at the end of the year less than it is at the beginning of the year? Well, there's a reason. Because money has a time value. And so the money at the end of, if I get paid at the end of the year, right, it's not the same as getting my money up front. And then in the middle of the year, I do a little better, but I still went the first 6 months without being paid. And you could see, and notice how we use the square root to reverse this power in the bottom, and that's how we end up with it. And that's really all that's going on here. I think the authors do a fairly decent job of trying to show you maybe a little bit more, detail as what would be a typical annuity, where you draw money out and money's put back. And literally, if you have an annuity, okay, and you draw it, literally what happens is they take what they're supposed to pay you every month or every quarter or however you arrange to have it paid, and then they reinvest it. Or if you've been smart, you have it in a money market or a bond or something where you're required to get that payment every year, every month, or whatever. Okay. Now, that should help explain, and I apologize about last night, but I was kind of rushing through those, and I didn't want to do it because we were hitting some important territory. Notice if we, the beginning of the year, the end of the year, and the middle of the year. And notice as we go deeper into the year in terms of getting paid, the less the present value of what we have. Okay? And to put it in the simplest terms, let's say you go to the store. You buy a carton of milk, a gallon of milk. It costs you $5, all right? And then in 6 months, you go to the store and it costs you $5.50. How much is its value? Well, you have just suffered a 5% inflation rate. 10%, excuse me. Because the milk costs 10% now than it did before. So we use this concept of present value to make sure that we consider. When do I get paid? How much do I get paid? And am I getting the return on this that I should earn? Now, what this tells me as as an investor, if the present value of the money is more at the beginning, then I want to pay in at the front end, all right, as opposed to the back end, because your money has less value. And over time, if you're paying for stuff on time and your payments at the end of the month, you'll end up paying more money. Because the present value of money is measured, you can even do it in weeks or days, whatever you choose to do. Okay, that's this file. All right. Now I'm going to close this off. And again, I have the annotation there for you to take a look at, as well as the formulas. And where the authors have got an R, typically you'll see a I or for interest rate, but that's the rate of return. And that's all that's going on there. All right, and I'm not going to save it. Now we're going to go to the last one that I want to talk about, okay? And this is the XNPV. And I'm going to download this. Now, I'm going to open this. I'm going to show it in the folder. Well, I don't want to do that here. I'm just going to go ahead and open the thing. All right, this is I want XNPV with annotation. I'm sorry. I don't want this one. Let's go down here. Yeah, that's the one I want with the annotation. I've adopted this text for the first time. This is the first semester I've used this text, and it's absolutely beautifully. It's a fantastic text. It explains in detail, great practical examples, but it's densely packed. And so as I go through it, I realized this week what I need to do is provide you some annotation. And it's easier just to cut and paste out of the text and throw it into a text file here in Excel than it is to keep referring back to the chapter and all that business. But I do have the book open here, and if you would want to check it, you could see. Now, I'm going to open up the XNPV with annotation. XNPV is for those situations where we have what we call irregular cash flows, okay? Where the cash, or what we call an uneven cash flow, okay? And we're going to see this now. And the authors pose this in this question: how can compute NPV and cash flows are received at irregular intervals? Okay. When we did the NPV, we assumed we're getting paid at the beginning of the year, the end of the year, or the middle of the year. Okay, or the period. Here, it's irregular. And notice we start off, and let's kind of set this thing up, all right? And here's the code. This is the date code. And we're using the codes for dates so we can figure out the amount of time between one date and another. That's all we're doing. And the authors go into this, and they use the NPV as of the first date, and you show the code, the date, the time, the discount, to show you the cash flows using the NPV and the dates between them, okay? This uses it from today's date, whatever that is. And you'll see we get paid, we have a date, we have a cash flow 0. Then on the 8th of April in 2015, we have a cash outflow of 900, and then we begin to get a series of cash inflows. So we use the XNPV because it does not assume a fixed period and fixed cash flows. It does not assume that. It assumes that they're irregular. So here's the NPV function. And we'll click on this and we'll take a look at it for a minute, talk about it. Here's the interest rate, the rate of return. That's over there in A11. It's 10%. Then the values are E3 through E9. He talks about that in the book, and he's a row or two off, but the values are E3 to E9. All right, and the dates are D3 to D9. So what XNPV does, notice it says, okay, here, what's the interest rate? Okay, what are the values? What are the cash flows? And then the dates for those cash flows. Okay, and there it is. And this is as of today. Now we can also do NPV as of the first date. And let's look at this. The rate is A9 over here, which is 1%. The date, the values, excuse me, are E3 to E7. Those are the cash flows. And the dates are D3 to D7. And that gives us the XNPV. Now here we do a direct method where we use a sum product and we take them times the discount factor. And the authors have this for you. Here's one. Okay, here's the discount factor. Now let's look at this for just a moment and think about what we're saying. The discount factor equals 1 divided by 1 plus A9, which is the interest rate, to the power on F4. Okay? And we'll come to the next one. And this is the power of F5. And this is F6 and F7. This time is this date here, most current minus the earlier, and that's divided by 365 to get it to days. That's all that's going on there. Okay, so it's a little bit of to do about nothing. Well, it's not about nothing, but the XNPV is mostly used when I have uneven cash flows or uneven annual net cash flows. Okay, we'll close this one off. And we got one more. And now we've got this mortgage rate, and let's go ahead and download it. Okay. And I'll do the usual thing of, enable the editing. Okay. And here's the amount borrowed. We borrowed $400,000. Now, I didn't go into the textbook and pull some annotations, so I'm wrong as far as that goes. Well, I don't even want this file. I want the annotated file, uploaded one. So I got ahead of myself here. Here it is. Mortgaged to a T with annotation. Most people buy a house payment, not a house. That is, how much can I afford every month to pay? Just like with cars, they'll sell you a car and the payment, and you make your decision as much about payment as you do about what you're buying. Okay. And so we'll open this up and we'll take a look at it. And I did, and I'll try when I think it's the tenses too dense or a little confusing to go ahead and do this using the annotation. All right. And they give us the business. We're going to build a home, 15-year repayment period. You're not sure about the interest rate. And we have our data table using one of the functions. All right, so we're doing a data table here. Here's the amount borrowed. Here's the number of payments. So this is a 15 years, okay? If you did a 30-year mortgage, you're looking at 360 payments. If you did a 20-year mortgage, you're looking at 240 payments. Now, let me say this. Most mortgage lenders want you to do 30 years. Why? Because they can charge you the highest. They can get the most interest rate out of you if you carry the home for the entire 30-year period. Now the chances are you'll sell the house, and if things are okay economically, you'll sell it for more than you bought it for, and so you'll make a profit. And that sale will go into the comparables for the neighborhood. And so when someone else comes along, they'll pay that higher price unless they can negotiate it down. But typically home prices go up. Well, we've got the number of months, then we've got the annual interest rate, which is 6%, and we've got the monthly payment. And here we use the payment function, and I want to show you that. And this payment function is very useful because you can also use it, okay, to figure payments on anything you buy. Let's click on this and let's see. Here we have the payment, okay, and we have the annual interest rate divided by 12. If the annual rate interest rate is 6%, then we divide that by 12 and we come up with 0.5%. That's the compounding period. And then the end period, there's the number of months. And here's the present value, that's the amount borrowed. Now, notice I don't put anything on the future value, and it's 0. It's assumed to be 0. You'll pay it off in type. Here's something very interesting for you to take a look at. On type, notice it says this is a logical value. Payment beginning at the beginning of the period. 1 equals 0. If you do the beginning payment is 1, a payment at the end of the period equals 0 or admitted, okay? So they're saying, are you going to pay at the start or the end of the month? Okay? Lenders will like you to pay at the end of the month. Why? Because it's a month of interest they can collect. If you pay at the start of the month or the beginning of the period, they lose that money. And a lot of times what they'll say is, well, and some of them will even say, gee, you could make your first payment in 45 days. Well, they're getting 45 days worth of interest. Or we love you so much, we're such a great lender that we'll go ahead and we'll give you 60 days. Aren't we nice people? Maybe not. But that's the payment. This could be a car, this could be a house, it could be a boat. Anything you buy on installment, the payment function is a fantastic function to work with. So we see what the payment should be. All right, and we get that payment. And we say, okay, how much am I going to pay, okay, in terms of monthly payments given a certain interest rate and the amount borrowed? And I have the verbiage over here for you to take a look at. And here we are. This is equal to D5. This is the hinge of our table. And here we have different interest rates. And here we have different amounts borrowed. And this says, okay, at these interest rates, given the amount borrowed, here is the monthly payment. And let's see if this is correct. Let's look for 6% interest, okay, and 300,000 borrowed, okay, and let's see what we've got. Yeah, it doesn't look right. We got D4 and D2. So that should be, we borrowed 300,000. No. We borrowed 400,000. Excuse me, everybody. We borrowed 400,000. I'm silly. Here, yeah, we're right. They equal. Now notice we use the equal. We use the table function again, and I'm going to do that. I'll just show you again. I'm going to copy this right here. Here's the annual interest rate. Here's the title for my little table, my data table. I'll put it right here. All right, annual interest rate. Then I'm going to get the interest rates. I'm going to copy them. Okay. And then I'm going to get my hinge. And this equals D5. And then I have my amount borrowed. All right. All right. And then I'm going to do the table function. And again, I'm going to do the row and the table. And we're going to see this. Here it's D4 and D2. All right. So I'm going to take my cursor and I'm going to cover all of this, all the way up to 8%, and borrowing $600,000, $650,000. Okay. And I'm going to click data. And the what if analysis, I'm going to use the data table. And, oh, I always forget these. I want D4 and D2. I'm sorry. And I want to go up to D4, which is the interest rate, yes. Now I'm going to explain this to you here in a minute, and the column output is going to be D4. So hang on here. I want D2, that's the amount borrowed, and then D4, which is going to be the annual interest rate. I'm sorry. Now let me show you this, okay? And I want to talk to you for a minute about this. You can see I kind of have to go back and look at something I've done, and I struggle with it a little bit. The row input cell is D12. Let's talk about that for a minute. And D12 is the amount of money I'm going to borrow, okay? The row input. So notice I'm taking D2, and here's the row. These are the rows. That's the row input. And then I'm going to do the column input, and that's the annual interest rate. So I do the row and the column. Now click that. Well, I didn't, so I'll go ahead and get these all done in here, and then we'll do our data. We'll do the what if analysis. Click on data, data table, and I want the row input, which is going to be D4. Okay. I think D4. And then I want the column input, which will be D2. I think I messed it up. No, I did it right. And I explained it to you totally wrong. Oh gosh, this makes the data table drives me nuts. Okay, let's go back and talk about that row column input and the row input and the column input. The row input is D4, okay, which is the interest rate. That's what I'm inputting into the rows. And the column input, I'm so sorry, is D2, which is the amount borrowed. That's as simple as it gets. Now there's some differences here, and we'll just do this. And what I've done is I'll just take this down to, and I'll go over to home, and I'll take it down. I'll put it into dollars. Okay, and I can take that and over here to home, and I'll click copy, format painter. And I'll just do a format paint for the whole rest of the thing. And we'll have to take these out a little bit. That's why I'm getting all that squinchiness there. That's all that's going on. So if it happens to you, don't panic. Let's move it out a little bit. And then I'll finish this up by do copy, format painter. And I'll get this along here. And here I'll have to move these out. Now again, okay, let's see if I'm correct at 6% and at $400,000 borrowed, I should have a payment of $33.75. 43, and I'm good. Now, I'm going to go ahead and use the conditional formatting. And I'm going to highlight this area. I'm going to click on conditional formatting. I use color scales. Okay. And I want to reverse this because I want the lower payment. So notice what I did here. When we did the profitability index, I used this green, yellow, red color scale, okay? When I want the lower figures, the lowest figures, I'm going to turn this around this time, and I'm going to do red, yellow, green. Red is too high, green is wonderful, okay? You see the difference? So here we're talking about minimizing the payments, and this shows you very beautifully a nice little picture of what that looks like. You can see the bands. And you can see at 400 grand at 6%, we are, let's see, 400,000, 6%, we're right near the middle. Okay? And that's got the notation. Now, if you really want to see something that will make you think, let me say this: home ownership has been traditionally the best way for any family to gain wealth. It might be a small amount of net wealth compared to a billionaire, but you still have some net worth and net value. Home purchasing you should never buy a home beyond your ability to pay for it and be comfortable, because you end up, what they say, house poor. To make house payment, you got to scramble around because you really bought something you couldn't afford. And a realtor and a good mortgage company or a good mortgage broker will walk you through what's the best rate that you have to have. And the banks and mortgage companies typically will not give you a mortgage beyond what they really are sure you can handle, because of the problems back in 2008 with the housing meltdown, where there was just a lot of there were people being written loans for a home who didn't even have any income. And you say, that's crazy. Yes, there's a lot of that. So I wanted to show you this so you could see. But you can see the extent to which interest rate, the house payments are driven by the interest rate and the amount borrowed. Notice over here, the lower the amount borrowed and even the higher, the lower the amount borrowed and the lower the interest rate, the lowest payment possible. Over here, it's just the opposite. Okay? I think that takes care of what we had covered last night. And I think it probably, and I'll close this as well, and we're not going to save it, will take us through these case XLSX cases that we had due. And those were, and again, we've been working ahead, okay, so that we can get to the access cases, and then I can give you some flex time to work on projects, work on your finals, that type of thing. So we've done down to XLS 11, and we're working ahead on those, okay? And then the next one we'll work on 12, and I have a 12 done for you, and I'm going to show you real quickly. Well, I'm just going to say that for you. You can go take a look at it and look at these as well. And then, yeah, we're going to have an XLS 13 as well. So we'll do some more work on those. Okay? All right, folks. Thank you so much. And I probably won't, many of y'all won't see till after break. So we'll see you then. This is this week. Well, okay, we've got to, this coming Thursday will be the 18th, and that's fall free days. And so we won't meet again until the 25th. Okay? Thank you so much. God bless you. Be safe if you're returning home. And I'll stop the share.